This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Seeking safety, investors dump stocks and flock to bonds as uncertainty looms over the outcome of the UK referendum. But just how worried should investors be? Buckle up why you may want to keep the money you're saving at the gas pump to pay for rising insurance rates. And America the Charitable. Who's giving, who's getting, as a new record is set for charitable giving. All that and more tonight on Nightly Business Report for Tuesday, June 14th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is on assignment tonight. Leave or stay? Investors around the world are starting to pay close attention to those few words. As we've been reporting, Britons will head to the polls next week to decide whether the United Kingdom should exit the European Union. The markets have largely shrugged off that threat, but that is starting to change. Over the past few days, volatility has risen and stocks have come under pressure as poll after poll show growing support for the Leave campaign. And that is why stocks were lower again today. The Dow Jones Industrial Average fell 57 points to 17,674. The Nasdaq was down almost 5, and the S&P 500 was off 3. As investors flee stocks, money is pouring into relatively safe investments, so much so that the yield on Germany's 10-year government debt fell into negative territory. The yield on the 10-year U.S. Treasury hit levels not seen since 2012. So let's turn now to our two guests who have opposing views on just how the U.S. economy will be impacted should the United Kingdom exit the European Union. Paul Christopher is head of global market strategists at Wells Fargo Investment Institute, and he says it will be negative for the economy and equities, while Nariman Behravesh, chief economist at IHS Global Insight, thinks that the impact will not be all that big. Gentlemen, welcome. Thanks for joining us tonight.
Thank you.
Let me start with you, if I could, Paul. Why do you think it will have a negative impact either on the markets or the economy or both?
I think it's going to be a complicated divorce, and one in which that will, first of all, push the UK into recession as investment there falls. But it will also create uncertainties and falling confidence on the continent itself, and that could undercut some of the progress we've seen in the economy there. I think it will at least slow Europe, and that will slow exports from the U.S. as well as revenues back to the U.S. from companies already operating there.
Mm-hmm. Now, Nariman, you are not all that convinced that this will be a negative event. Why?
Well, let's be clear. I think it will be negative for the UK. I don't know that it'll push them into recession, but it'll reduce growth quite substantially, maybe to only 1% growth next year from 2.5%. Same thing with Europe. It'll cut their growth. But the good news for the U.S. is we don't export that much to Europe. They're a fairly small export market for us. But there'll be a big offset in the sense that global interest rates, including our interest rates, will be lower. And there'll be a flight to safety in the sense of U.S. bonds, even possibly U.S. stocks after the initial shock. So I think there are sort of negatives that'll offset this export shock, if you want to call it that, which will be tiny, I think, in the end.
Now, polls can always be wrong. I mean, we saw that in the Scottish independence vote as well. So, that's one caveat to this discussion. But, Paul, if indeed we do see an exit vote, a leave vote carry, there's growing concern that other members of the EU who have been under pressure, Greece comes to mind, might decide to follow suit. Is that a real threat?
It's always been a threat, Sue, but I think if Greece is not going to go and Greece hasn't been pushed out yet, that's maybe the more important way to think about it, then it's unlikely that anyone else is going to leave anytime soon, especially, if you try to leave the European Monetary Union. That's a little bit different story. That's a more tightly knit group, right? If you have to change your currency in order to leave the group, that makes it more complicated to leave.
Nariman, does this complicate the already complicated election cycle? Because at this point, there are those who say that it would be a damaging situation for Ms. Clinton if indeed she prevailed in the election.
Well, I think it's, you have to kind of separate it out a little bit. I don't think that the Brexit, as it's been called, Britain leaving the European Union, has that big an effect on the economy or even the U.S. electorate. I mean, frankly, I think the U.S. electorate isn't paying that much attention to this situation. I think it does have ramifications for the Federal Reserve. I think if they decide to leave, I think this will put the Fed on hold a lot longer than it otherwise might have been. So it will mean interest rates will stay lower longer for the U.S., which is not necessarily a bad thing for the economy.
Right. Paul, would you agree with that aspect of it?
Yes, we would agree. We're only looking for one rate hike this year as it is, even in the best of circumstances. We think if the Britain's vote to leave, it could complicate matters further for the Fed, and we could see that pushed out a bit.
Nariman, do you think that the market is overreacting to this?
Well, markets hate uncertainty, and this is a huge uncertain event. So overreaction is perhaps too value-laden a word. I mean, they clearly are unhappy about this and don't fully understand all the ramifications. So I'm not surprised there's a fair amount of market volatility around this. Once it's decided one way or another, I think the markets will settle down.
Finally, I'd like both of you to cast your vote. Paul, would you? What's your handicap? Are they going to stay or leave?
I think they'll stay.
Okay. Nariman?
I'll agree with that.
Okay. On that note, gentlemen, great to have you with us.
Thank
Paul
you, Sue.
Christopher with Wells Fargo Investment Institute and Nariman Baravish with IHS Global Insight. Well, that UK referendum, along with concerns that global central bank policy is becoming ineffective, is causing investors to hoard more cash. The latest Bank of America Merrill Lynch Global Fund Manager survey shows cash levels are at 15-year highs. But despite all of the concerns in the market, consumers are still spending. Retail sales, a key gauge of consumer spending, posted a solid gain last month. The Commerce Department reported a 0.5% rise, which was above expectations. Households have benefited from steady job growth, reduced debt, and rising home prices. And prices for imported goods rose at their fastest pace in more than 4 years last month. That's the third monthly rise in a row. Most of the gains came from oil-related products, whose prices have been climbing over the past few months. Federal Reserve policymakers today began their two-day meeting on interest rates. Just a few weeks ago, many thought a rate hike might be likely, but a weak jobs report and increasing concerns overseas seems to have changed all that. Steve Leisman tells us what the nation's top economists, market strategists, and money managers are now looking for.
The CNBC Fed survey shows that Wall Street expects a more dovish Fed, pushing later the expectation for that next rate hike from August to September. Let's also look at the outlook for interest rates from our 41 panelists from the street. 0.7% is the expectation for the funds rate in 2016, 1.5% for 2017, 2.2% in 2018. And the long run, they think the Fed will settle down at 2.6% for the long run. Notice that each one of these points is below where the average member of the Fed is. We'll get new numbers from them at the announcement at 2 o'clock tomorrow. How about the S&P? Expectation is that we will recover. We have recovered the optimism we had before the market swoon in January and February, looking for 3.4% up by the end of 2016 to 2149 on the S&P, and up about 8% to 2244 by the end of 2017 from the current rate of 2,079. Let's take a look at the biggest threats to the U.S. recovery. 28% say it's global economic weakness, and 28% also say tax and regulatory policies here in the U.S. Rising interest rates, 25%, and protectionist trade policies, 13%. First time we've had that on the radar. Terror attacks in the U.S., this was done before the events, the horrific events in Orlando, registered 0, and they have never registered high, even after the terrible attacks in San Bernardino. So look for the Fed to hold interest rates steady at the meeting when the announcement comes at 2 o'clock. For Nightly Business Report, I'm Steve Leisman.
Concerns over the impact of a so-called Brexit on the U.S. economy continue to push U.S. bond yields lower, yields which mortgage rates loosely follow. And with rates near lows, that lenders are now more focused on credit availability, which has been tight since the financial crisis. The nation's largest lender convened a panel of experts to voice concerns and potential solutions in Washington today, and Diana Olick was there.
And the kitchen's really a good size.
A growing number of Americans say they are considering buying a home. In fact, 40% of millennials say they probably or definitely will in the next 2 years. That's according to a new survey by Wells Fargo. The trouble, says the nation's largest mortgage lender, is that these potential buyers are misinformed about mortgages.
We see 3 myths. One is that you have to have a 20% down payment, which we know is not true. There are programs for less down payment. Number two, you have to have perfect or near perfect credit. And number three, you have to have high incomes.
Wells Fargo recently launched a 3% down payment loan backed by Fannie Mae targeting first-time buyers. It is fully underwritten and does require mortgage insurance, but it's designed to be cheaper and simpler than the government-backed FHA loan. Codell says in just a few weeks, Wells has seen strong demand and expects more.
We think the next few years are going to be a period of high growth for new homeowners coming into the marketplace.
Because according to housing experts Codell gathered in Washington Tuesday, since the recession, lending has been far too tight. If lending were just back to the pre-boom standards of 2001,
there would have been 1.2 million additional loans in 2014. Cumulatively, 5.2 million additional loans from 2009 to 2014 with a more reasonable set of credit standards, and this is something that we can do something about.
But former FDIC Chairman Sheila Bair argued the 3% down Wells Fargo product is deja vu all over again.
So you have that really, really low down payment. Even from a borrower's perspective, you're exposing yourself to risk if home prices take a dip.
Wells Fargo's new product may help some home buyers, but the trend toward easing credit standards appears to be tapering off, at least according to a new report from Fannie Mae. 90% of lenders it surveyed said they were keeping credit standards about the same. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, hitting the road. As Americans drive more, they may be in for some unexpected sticker shock. The Obama administration was handed a major victory in its effort to increase oversight of broadband services. A federal appeals court ruled that the Federal Communications Commission's net neutrality rules will remain in effect. That means phone and cable companies must treat all of the traffic on their networks equally. No blocking or slowing their competitors, and no fast lanes for companies that can pay more. Opponents of the rules plan to take their challenge to the Supreme Court. Congress approved a $28 million shift in funding for the Transportation Security Administration. The approval allows the TSA to allocate more money to where it's needed most, like day-to-day operations at airports, which includes converting more than 2,700 officers from part-time to full-time. The additional workers will theoretically open up more airport security lanes and, in theory, ease the wait times as well. The computer systems of the Democratic National Committee were breached. According to reports, a group of hackers linked to the Russian government are believed to be behind that attack. They are the same groups that successfully penetrated the unclassified networks at the White House and the State Department. The hackers gained access to the entire database of the opposition research on Donald Trump. It is one of the largest known breaches of an American political organization. Defense stocks moved higher after the U.S. Senate overwhelmingly voted to pass a $602 billion defense authorization bill. This despite the president's threat to veto that measure. That sent shares of defense companies higher, including Lockheed Martin, Raytheon, Northrop Grumman, and Boeing. John Harwood is following the story from Washington. So, John, what's in the defense bill that the Senate passed today?
Well, most importantly, Sue, is that $602 billion that you mentioned. But there are also policy provisions that are controversial in some quarters. One would require women to register for the draft if we return to a draft, limiting the long prohibition or the limitation on the draft to only men. It would prohibit President Obama from closing Guantanamo. It would reorganize some aspects bureaucratically of the Pentagon, and it would limit the size of the National Security Council staff.
And those are some of the reasons that the president has threatened to veto the bill. So what happens now?
Well, what happens now is the House has passed a different version of the bill, and the real negotiating is going to start on just what the final shape of this is going to be. We'll have to see how hard the White House hangs out with that veto threat, and what is their bottom line? Is it about Guantanamo? Is it other provisions like the limits on the National Security Council staff? All of that over the next few weeks is going to unfold between House and Senate negotiators.
Yeah, speaking of national security, the president met today with his national security team and spoke about security threats following the horrific Orlando terrorist attacks. What, generally speaking, was his message?
Well, this was extraordinary, Sue. In addition to giving updates on the fight against ISIS and the investigation into the Orlando terrorist attack over the weekend, President Obama fiercely went after Donald Trump's suggestions that Muslims be barred temporarily from the United States and suggestions that as a group, Muslims need to be watched more closely. The president called those ideas un-American, dangerous, counterproductive. They would enhance the recruiting of extremists around the world who would threaten the United States. You rarely see as much passion as you saw today from President Obama in going after the ideas being spread by Donald Trump, whose name he did not mention.
Yes, indeed. Very true. John, thank you very much. John Harwood for us in Washington tonight. Synchrony Financial warns of steeper than expected loan losses, sending a shiver through the credit card industry. And that's where we begin tonight's market focus. The largest retail store credit card issuer said it sees higher than expected loan defaults by consumers this year. The company sees charge-offs or the amount of debt that it's not likely to collect higher than originally thought. The news sent shares of Synchrony to its biggest one-day loss since going public 2 years ago. Shares fell 13% to $26.45. And other credit card issuers like Capital One, Discover, and American Express all suffered big losses today as well. Citigroup is bullish on Vonage. The bank raised its rating on the digital phone service provider to buy from neutral, and it also raised its price target on the stock to $8, up from $4.75. Citi analysts cited a favorable risk-reward scenario with a revenue growth opportunity for the upgrade. That sent shares up more than 12% to $5.34. Alibaba sees a big jump in sales this year. The Chinese e-commerce company expects revenue to rise 48% as it anticipates benefiting from recent acquisitions and stock buybacks. Analysts were expecting a 40% increase. Shares rose 3% to $77.77. And Xerox has named a new CEO of its business process outsourcing division, who will take over after that unit is spun off later this year. Ashok Murray has been the CEO of IT services provider iGate until October. Shares of Xerox fell more than 1% to $9.73. Low gasoline prices and an improving economy are expected to fuel a record number of drivers on the road this summer, but they may want to keep the money that they save at the pump to start paying for rising insurance rates. Mary Thompson reports.
U.S. drivers seen hitting the roads in record numbers this year, and that means they'll be hitting their brakes and each other, too.
People are driving more miles, and they're getting into more accidents.
More accidents mean more claims, and that means insurers need to pass on the cost through higher rates. Data from the Insurance Information Institute shows spending on auto insurance is up 18.5% from 2009 to 2015. And if you're expecting a break this year, don't. April's Consumer Price Index shows spending on auto insurance rose an unadjusted and hefty 6%. A downside, says the Insurance Institute's James Lynch, to an improving economy.
When people lost their jobs in the Great Recession, obviously they stopped driving. Their cars sat in the garage where they weren't exposed to accidents. So there weren't as many accidents.
Other contributors to these higher rates are bad roads, which damage cars, a higher number of which are new and more expensive to repair. The cost of treating anyone hurt in an accident on the rise as well. As for insurers, some are raising rates more than others, the increase reflecting the number and dollar amount of claims filed by clients. Allstate pushing through a bigger rate hike following an unusual uptick in loss trends last year.
Historically, their loss trend has been 2 to 3%, and last year it was over 9%.
Citi analyst James Naklicki says higher rates should benefit Allstate in the long run, though rival Progressive is seen being hurt in the short term for forgoing larger than average rate hikes in hopes of attracting more clients.
Their business is skewing more towards low profitability new business. So the reason for the sell there is I think margins will be pressured in the near term.
Rate hikes driving profitability for some while keeping the brakes on higher prices, helping other insurers bring more clients along for the ride. For Nightly Business Report, I'm Mary Thompson.
And coming up, the fast-growing gaming industry is undergoing a massive shift, and there's more competition than ever. Here's a look at what to watch for tomorrow. As we reported, Fed Chair Janet Yellen holds a news conference after releasing the central bank's statement on interest rates. We'll get a fresh read on inflation when the government releases its producer price index for May, and weekly mortgage applications are due out. And that's what to watch for on Wednesday. The video game industry is at a turning point. Mobile gaming is more popular than ever, and virtual reality is starting to go mainstream. Nowhere is that more evident than at the annual video game trade show in Los Angeles. And that's right where we find Julia Borston.
The video game industry is in the midst of massive change. Virtual reality and competitive gaming, or esports, is on the rise, as this year, mobile gaming revenue is poised to overtake PC gaming for the first time. And new consoles are in the spotlight. Microsoft announcing a slimmed-down console, the Xbox One S, and a next-generation 4K console, Project Scorpio, which will support VR and launch in 2017.
We and Sony feel great about this console generation. It's actually moving faster than the previous generation. So we feel great about console gaming. And I think hats off to Sony on their progress. We're really thrilled with our progress. Xbox is growing, sold more units than we've ever done before.
But Xbox is also facing more competition than ever from Sony, whose PlayStation consistently takes the lead in console sales. Sony unveiling long-awaited details for PlayStation VR. It'll cost $399 and will launch in October, with 50 virtual reality games available by the end of the year. While console makers compete for customers by showcasing exclusive video game content, this year the video game makers have pulled out of E3 with no presence here on the Convention Center show floor. Instead, Activision and Electronic Arts are investing in their direct digital relationship with consumers with the likes of video game competitions, otherwise known as esports. Electronic Arts announcing it's putting $1 million in prize money towards an Esports for Everyone initiative. 3 different tournament levels from professionals down to communities organizing their own face-offs.
And we're not focusing just on the elite levels of esports, but competitive gaming overall for the entire community. And I think that you're going to see engagement and increased profitability overall almost immediately.
The more esports events like these connect players to game makers, the more they can sell digital add-ons and content, and the more the likes of EA and Activision can make sure they are in demand, no matter which consoles gamers buy. For Nightly Business Report, I'm Julia Borston in Los Angeles.
The nation's largest banks collected more overdraft fees from their customers in the first quarter than they did a year ago. The Washington Post, citing new government data, reports that Wells Fargo saw the biggest jump, up 16%. Bank of America and J.P. Morgan, the country's largest bank, saw a 6% increase. The total amount collected by more than 600 banks during the first 3 months of the year rose to more than $2.5 billion. Microsoft's $26 billion purchase of LinkedIn, which we told you about yesterday, has created a multi-billion-dollar payday for LinkedIn's chairman, Reid Hoffman. Now, given Hoffman's stock ownership, his take from the all-cash deal could be nearly $3 billion. But with that windfall comes a big tax bill. Hoffman would presumably be subject to both California and federal taxes. California taxes capital gains at a rate of 13.3%. Combine that with a federal capital gains tax rate of 23.8%, and his tax bill could be more than $1 billion. It's unclear which, if any, measures Hoffman will take to reduce the amount he may owe. In the wake of the terror attack in Orlando, Disney is donating $1 million to assist those affected by the shooting. Eligible donations from Disney employees will also be matched dollar for dollar. And speaking of donations, Americans were more charitable last year than ever before. And it wasn't just the wealthy that donated. Robert Frank takes a look at America the Charitable.
Americans opened up their wallets for charity last year, setting an all-time record for giving. Charitable giving hit $373 billion in 2015. According to the Giving USA report, that's up 4% from the year ago. So where did all that money come from? Well, individuals gave the most, $265 billion, with the rest coming from foundations, estates, and companies. And believe it or not, much of the giving in America is still in the form of $10 or $20 gifts from everyday Americans.
Americans are incredibly generous. They care deeply about those causes that they want to support, and they want to make a difference with their giving, whether it's locally, nationally, or internationally with their giving.
So where's all that money going? Well, religious groups dominate, accounting for about a third of the total. Education ranks second, followed by human services, which includes donations of food, clothing, and shelter for the poor. Giving to the environment and the arts also saw strong growth. But the fastest growth in giving is still in international affairs, which includes overseas disaster relief, human rights, and medicine. The flow of dollars shows that today's donors see their charitable giving more as investments in solving social problems rather than just handouts.
There's an opportunity for them as they think about their giving. They're really, to some degree, investing in impact. They want to make sure that their gifts are making a difference.
And Americans aren't just donating cash. With prices for fine art and other collectibles soaring in recent years, gifts of artwork and other so-called appreciated assets also saw strong growth. For Nightly Business Report, I'm Robert Frank.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Have a great evening, everybody. We'll see you right back here tomorrow.